Hi, here is another video PowerPoint about banks and banking. What is a bank? It's a financial institution that receives deposits. Deposits are money that savers like you and me put in the bank, and banks make loans. So here is a bank that you guys might be familiar with, and people come in, they deposit their money, and other people can then come and get, whoops, other people can then come and get loans, and the bank loans out your deposits. How do banks work? Basically, here are you and me. We're the depositor. We put in our savings, we put in our paycheck. Here it's $1,000. We put it in the bank. The bank then lends out that $1,000 to a borrower at, let's say, 10% interest. I'm sorry, I know that's a little hard to read. And so 10% of $1,000 is $100. This borrower pays back $1,100. So the bank's made $100. They keep some of that money and they return some of that money to you. I kind of don't like this diagram. I think it's a little sexist because it's just men. Anyway, how do banks work? Again, you place your money in a savings account. Here you're doing that. The bank uses that money to lend to other people and other businesses. So maybe this construction company can build a building. That company then has got to pay back the loan by this date, and the bank pays you interest for using your money to make the loans. And the bank keeps the difference. That's the bank's profit. Here's another look. Number one, you deposit money in the bank. Step two, the bank loans out your money to people so they can buy a house or go to college. The bank charges interest on the money it loaned. Then that money gets paid back, okay? And the bank then pays its employees, pays its bills like a phone service, and the bank pays you interest since it borrowed your money. And with the money that's left over, the bank puts it in its pocket. That's the bank profit, and the cycle starts again. So you make money by depositing money in the bank and getting interest. It pays to save. That's an incredibly important concept to understand. When you put money in the bank, it does not just sit there. Your money grows. The bank pays you interest. So it pays off to save. And the bank makes a lot of money by lending out your money and my money and his money and her money and getting interest back. So some of these US banks are absolutely enormous, okay? Like JP Morgan Chase, Bank of America, Citibank, Wells Fargo. These are absolutely huge. In Boston, you've heard of TD Bank, okay, and they bought the naming rights for the Celtics and Bruins sports arena. These banks are huge, okay? Here again, you see the four big ones. They've got a lot of assets. They've got a lot of global branches where you can go in and put your money, and they've got a lot of deposits. And so in terms of their stock value, these are absolutely huge companies. Please remember that U.S. banks are monitored and affected by the Federal Reserve, the Fed, whose headquarters is down in Washington, D.C. We talked about this before. The Fed affects bank interest rates by changing the open market operations, the discount rate, and the reserve requirement ratio. That, in turn, affects the federal funds rate, and you can review this if you want to, but basically the Fed makes loans to banks and banks make loans to us. The largest banks in the world are absolutely enormous. Here you see JP Morgan Chase, that's American, Bank of America, Wells Fargo, here are the American banks. China also has some absolutely enormous banks. You know that China is a big country, and also the government is run by the Communist Party, and they pressure these banks to make loans. All right, why should I use a bank? Well, the first reason is for safety. A robber Or your younger sibling, your younger brother or sister could steal your money if you kept it in your sock drawer. That's not a good place for it. Second, you bank to earn interest. Remember, interest is the price of money. If you put your money in your sock drawer, it earns no interest. It just sits there. So after inflation, remember inflation's rising prices, life's getting more expensive, the money in your sock drawer actually decreases in value because it's just sitting there. You want to put your money in a bank. The bank will pay you interest, so your money will grow, and that's important because of inflation, because expenses are growing also. A third reason to bank is direct deposit. Direct deposit is when your paycheck is directly deposited electronically and automatically into your bank account. That makes it easy to save money. It happens automatically, electronically, and you start to earn interest immediately. Also, if you bank, you can write paper or electronic checks, which makes it easier to pay your bills. Online banking makes it really easy to manage your money. You can sit at home, you can lie in bed and pay your bills and see how your money's doing. Also, if you bank, you can get a debit or ATM cards, and that makes it easy to get money. Debit cards withdraw money out of your bank account immediately, and you can use an ATM card to get money out of the ATM. Usually those cards are one and the same. Also, you want to bank to develop a relationship with a bank so that they will one day give you a loan. You might want a loan for a car or college, a house, or a business. And 8, if you deposit money in a bank and I do it and she does it and he does it, then the bank can lend it out to other people so they can get a loan for a car, college, house, or business. So it's good for you individually and it's good for society. It's good for the economy because other people can go to the bank and get loans. All right. How do I use a bank? Well, first, how do I pick a bank? Don't automatically use the bank that your parents or older siblings use. Their bank might not be the best one for you. It might be terrific for you. It might be bad for you. You got to do your homework and check it out. Try to find the best bank for you. How? You're going to look at our chart, our worksheet, and I'll show that to you. Whoops. It's right here. I'm going to assign this to you for homework, and you're going to fill it out for one bank in this column and another bank in this column. And you'll see here there are a bunch of categories, a bunch of considerations you need to take into account. And there are a bunch of terms here that are going to be new. So I want to explain those terms. To pick a bank, you need first to understand some key terms, which are explained over the next few slides. Then, for homework, you're going to practice by choosing one of these two banks, and I'll give you 2 banks for homework. All right, let's start with the key terms. In 1933, the Federal Deposit Insurance Corporation started. It's called the FDIC. It's part of the federal government, and it insures deposits up to $250,000. How does that work? Well, banks pay the FDIC a monthly premium, a monthly amount, just like we do with our car insurance. We give the car insurance company money each month, and in exchange, they give us a coverage. They give us an insurance policy. In this case, in exchange, the FDIC insures bank deposits. So the FDIC will reimburse, will pay back the depositor in case of emergency if something happens to the money. So here is Franklin D. Roosevelt, the president, back in the 1930s, signing the law that set up the FDIC. And by the way, you'll notice that back then, unfortunately, we didn't have many female politicians. We didn't have many politicians of color. So you see a lot of white men here. All right, here's the FDIC headquarters in Washington, D.C. How can you tell if your bank is a member of the FDIC? You should look for this sticker on the bank door or the bank window. If you're looking on the website, scroll all the way down to the bottom and you'll see things like member FDIC. Why do you always want to use only FDIC member banks? Again, because your money is insured up to $250,000. So if the bank ran off with your money to Hawaii, or if there was a fire or a flood or a terrorist attack or something happened and your money was lost, the FDIC would pay you back. This incentivizes people to put their money in banks. All right, other important banking terms. The National Credit Union Association, the NCUA, they insure credit union deposits. So it's like the FDIC does for banks, but the NCUA is for credit unions. What's a credit union? It's a bank, but it's owned and run by its members, by its depositors. So the fees it charges you are lower, cheaper, and the interest it pays you is higher, better. Well, that sounds great. How can I join one? Usually, only certain jobs make you eligible. For example, I was a teacher in Baltimore, and so I could join the Baltimore City Credit Union. It's often open to police officers, firefighters, government employees, or their family members. So if you have someone in your family who's a cop, a police officer, works in the city government or state government or federal government or something like that, you might be eligible to join a credit union, and they usually give you good terms. The City of Boston Credit Union says membership is open to anyone who qualifies in any one of the following ways. Persons who attend school or live or work in Middlesex, Norfolk, or Suffolk counties. So that's basically Boston and the suburbs. So a lot of you are eligible. And persons whose salaries are paid in whole or in part by the City of Boston, Commonwealth of Massachusetts, or any department. So again, if someone in your family is a city or a town or state government employee, you might be eligible, and credit unions usually offer good terms. All right, some more important banking terms. Direct deposit. We talked about that. What is direct deposit? It's when your paycheck is automatically, immediately, and electronically deposited into your account. Why is that good? It saves you time, gas money. You don't have to go to the bank to deposit the check. You start to earn interest immediately on payday. You don't have to wait several days till you deposit your paycheck in person. So it's really good. Let's say you get paid on Friday. Electronically, the money goes into your bank automatically and you start to earn interest. The alternative, you have the check in your car, you'll go to the bank tomorrow, the next day, and then you've lost a couple days worth of interest. So you want to fill out a direct deposit form after you get hired. It's really easy. Here's an example of a direct deposit form that you would fill out and you would give to the Human Resources Department or Payroll Department. It takes a couple minutes. You just write down your name, address, city, state, and zip. You attach a copy of a check, write the name of your bank. You write your account number, which is the second number at the bottom of the check. You write the routing number, which is like the bank identification number. Okay. And then you can put down the amount that you want directly deposited each week, or you could do it as a percent, or you can check off your entire paycheck. You can send it to your checking account or your savings account. You sign it at the bottom. You attach a voided check that you just write void on top of. You staple this together and you give it to the HR or payroll department. Now they know which bank you use and which bank account to send the money to. Really good idea. All right, important banking terms continued. Some bank accounts require you to have an initial minimum balance. What is that? It means that you need at least this amount to open an account. Maybe it's $50, maybe it's $100, maybe it's $1,000. You also need to know what a minimum required balance is. It's your account balance, your account amount must stay above this amount, this minimum, for you to keep this account open and or to avoid fines. So there's some bank accounts that are really great and they'll pay you a lot of interest as long as you keep it above $1,000 or above $2,000. That would be a minimum required balance. Again, the balance is the amount you have in the account. A savings account. Savings accounts are great because they pay you interest for your deposit, but they offer limited or no check writing. So that's why a lot of people also have a checking account. The problem with the checking account is it doesn't pay you any interest for your money in the checking account, but you can write checks, write paper checks, or send electronic checks, and it's really useful to pay your bills. You do not want to bounce a check. Bouncing a check is when you write or send a check for more money than is in your account. Banks will often charge you a fee or a fine if you bounce a check. Basically, processing your check is a pain in the butt for the bank. It stinks. They don't make any money off it. So when you write your little cell phone bill and you send in that check, the bank's got to deliver the money to the cell phone company, and it's a hassle for the bank, and it stinks, and they hate it. They would rather make loans and make money off that interest. So they don't like it when you bounce a check, and they will charge you a fee or a fine. Overdraft. Overdraft is when you take out more money than you have in your account. Banks will often charge you a fine or fee if you overdraw. It's another way that they can make money off of you. You do not want to overdraw your account. Some banks offer overdraft protection. That's when the bank prevents you from spending or withdrawing more money than is in your account. Overdraft protection is good to have. Lots of times, let me give you an example. Let's say you have $10 in your account and then you withdraw 15. How is that possible? Well, the bank basically says you overdrew. We'll give you a $5 loan. Since you had $10 and you pulled out 15, we're going to call that a $5 loan. They're going to charge you a really high interest rate and a fee or a fine. So you don't want to overdraw. It's good to get overdraft protection. All right. Another key important term is a certificate of deposit. All right. This is our last important vocab term. A CD. A CD is a type of savings account. When you buy or get a CD, you agree to give the bank your money for a longer period of time. In exchange, the bank agrees to pay you a higher interest rate than a regular savings account. So let's look here at some examples. You could buy a 3-month CD. Let's say a $2,000 3-month CD. So you're going to give the bank $2,000 and the bank can now lend it out for 3 months. The bank says, thank you very much, and they're going to give you a higher interest rate than they would in a regular savings account. The longer the CD, the better the interest rate for you. For example, let's say you bought a 60-month CD. All right, that's 5 years, right? 5 times 12 months is 60. So you buy a 5-year CD. That means you're giving the bank that money for 5 years. You're locking it away in the bank. The bank turns around and lends out that money, and look at that. They pay you an interest rate that is considerably higher. So if you can do without that money for a longer period of time, a CD is a good, safe way, okay, to earn more interest. You know, EP2 are choices of costs and consequences. What are the pros and cons, the costs and benefits of a CD? First of all, it's really secure. You're going to get back your money plus interest. Also, there's a fixed interest rate that the bank promises, so you're going to make money. But there are potentially higher interest rates elsewhere. And maybe you could put your money in stocks or bonds and your money would grow more. Okay. That's why it says here it's got lower rates of return than other investment accounts like stocks or bonds. CDs are really easy to open. You can do it online, you can do it at a bank. What are the cons? What are the problems with CDs? Again, your money is basically locked away for 3 months or 9 months or 36 months. So it's not accessible. You can't get at your money. There are fixed rates. So if interest rates elsewhere went above 2.3 or 2.35, then you could have done better in those other accounts, but your money is locked away in this CD. Again, a CD is not going to grow as fast as other investment accounts like stocks or bonds, and we'll talk about those in the future. If you do need to get your money out, you can, of course, it's your money, but there's an early withdrawal penalty. There's basically a fine to get your money out early. All right, that's the bank vocab. Second, how do I open an account? It's easy. Usually, all you need is some money, a form of identification, a signature, and your social security number. Remember, you always want to be careful who you give your social security number to. Keep it private. You can give it to the bank, but you want to keep it private. If you have bad credit history, unpaid fees at other banks, or if you've bounced many checks at other banks, this bank might deny you an account. So you got to first fix your credit situation. But in general, super easy to go to a bank and open up an account. All right, third, how do I write a check? You can also send checks electronically on your bank's website. This is called online banking. But this slide explains what you're actually doing when you fill out a paper check or when you send an electronic check. First of all, let's look at the parts of a check. Here's your name and address, and here's the date. This is who the money is going to, and here you write the money in number form and you write it out in words just so that you don't make a mistake or the bank doesn't make a mistake. Here you put a memo. Sometimes when my wife and I pay a babysitter, I'll put babysitting or whatever. If I pay for my kid's math tutor, I'll put down here, thank you, whatever. And then, of course, you have to sign it. The lower left number is your bank's routing number. That's the bank identification number. And right here, this is your account number. And this is the check number. You see here, this is check 101. All right. So this is some personal information. And of course, your name and address. You don't want to leave your bank, your checks lying out. When you go to college and you're in your dorm room, you don't want to leave your checks out. Put them away. And this is an example of a check filled out. You never want to leave a signed check blank where it only has your signature. Why not? Obviously, someone could come along and put in any amount, so you don't want to do that. Fourth, how do I balance a checkbook? These days, if you look at the bottom of the slide, most bank websites and bank apps on your phone will balance your checkbook for you. But you should understand what's happening, and you're going to do this for homework. In the old days, we did this actually on paper. So let's say this is your starting balance, your starting amount. You have $140 in the bank. Then you have to pay your electric bill. You pay with check number 314. It's an $80 bill. So you subtract $80. Now you're left with $60 in the bank. This is nice. You get paid by your employer. You set up direct deposit. So on May 1st, $1,500 is going to be deposited into your account. Now you're plus $1,500 plus the $60 balance you had before. Now your balance is $1,560. Then you wrote check 315 to Jane Doe. It's a $30 check, so you subtract that. You pay your Netflix bill, $10, so you subtract that. And here you can see your balance, how much money you have in your account. Then you go to the supermarket, you buy your groceries with your debit card. That's DC. It costs you $85. Subtract $85, and you can keep track of how much money is in your account. Again, these days, your app, your website will do it for you. You should understand what it's doing. All right, just a little side note here at the end. What kind of architecture did many banks used to have? If you look here with the columns and the pillars and the capitals and the pediment here, this is Greek and Roman architecture. Why did banks have that kind of architecture? What message or signals were banks trying to send to customers? The banks were trying to tell the customers, we're trustworthy, we are safe, we're a big, established, important institution, we're going to be here for a while. If you come up to the counter and give us your money, we're going to be here next Thursday, next week, next year. We're going to be here for you. So the architecture was designed to convey a sense of trust and responsibility and permanence. Now, many banks try to have architecture that's modern and open and inviting. Why? What message are banks trying to send to current and potential customers? Well, if you look here by the colors and you look here at the posters, you'll see they're trying to be inviting. Look at the interior architecture. What feel or sense does the bank want the customers to have? They want the customers to feel welcome and feel at home. Okay, so this is open, comfortable decor. Now, bank websites try to send the same signal. So if you look here, what is that signal? And you can look over here at this credit union homepage. All right, they're trying to show you that banking it's fun, it's hip, it's cool, young, cool, fun, hip people do it. Here, oh, come on, parents, you want to think about your cute, lovely little daughter at home and the cute dog, take care of your money so that your daughter will have this wonderful life. So websites are trying to convey that. Happy banking, and if you have any questions, please let me know. Thank you.